Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discussed is intended for information and educational purposes only and should not be considered investment advice or investment recommendation. If you've done research on stocks you're interested in buying, you may have come across these sectors before. These are the GICS sectors, or Global Industry Classification Standard. GICS or GICS is a system developed by MSCI, Morgan Stanley Capital International, and S&P Dow Jones Indices to classify companies into different industry sectors and sub-industries. The GICS consists of 11 sectors, each divided into various industry groups, industries, and sub-industries. The sectors are as follows. Energy. Companies involved in the exploration, production, and distribution of energy, including oil, gas, and renewable energy sources. Materials. Companies engaged in the extraction, processing, and production of raw materials such as metals, chemicals, and forestry products. Industrials. Companies involved in the production of goods and services, including manufacturing, aerospace, defense, and transportation. Consumer discretionary. Businesses related to non-essential goods and services, such as retail, automotive, travel, and entertainment. Consumer staples. Companies that produce and distribute essential products including food, beverages, household goods, and personal care items. Healthcare. Businesses in the healthcare industry including pharmaceuticals, biotechnology, medical equipment, and healthcare services. Financials. Companies in the financial sector including banks, insurance companies, real estate, and other financial services. Information technology. Businesses involved in technology, software, hardware, and services related to information and communication. Communication services, companies providing communication and media services, including telecommunications, entertainment, and media content. And utilities, companies that provide essential services such as electricity, water, and gas. And finally, real estate, business involved in the ownership, development, and management of real estate properties, including REITs or real estate investment trusts. Each sector is designed to encompass companies with similar business activities. This classification system is widely used by the global financial community for investment research, portfolio management, and benchmarking. It helps investors and analysts compare companies with the same industry to make more informed investment decisions. However, here's the problem. These sectors kind of suck for finding natural dividend payers that investors like us want for our income portfolios. Let me demonstrate with an example. One of the worst offenders here is the so-called communications sector. Now, in the communication services sector, the following three stocks are all included. AT&T. Okay, fair enough, this company helps to facilitate communication through its infrastructure and its network. And then Meta, or what was originally called Facebook. Okay, this one is mainly a social network where people communicate, so it has some function of communication with it. I guess it makes some sense. And then it also includes Netflix. Media is communication, I guess, but it feels like a bit of a stretch. Now the problem is, how do we compare AT&T's financial and business model to Netflix or Facebook? They're completely different. Let's look at a snapshot of each. So first we have AT&T. We can look at a few of the metrics here that will really show how different it is. First, dividend yield is relatively high. It's 6.61%, which is much higher than the market average. Its PE ratio is 8.02. And if you're not sure what this means, it's the relationship between the company's stock price and the earnings per share. So the lower the PE ratio, the less you're paying for $1 of profit per share. With that in mind, lower PE ratio means the stock is potentially cheaper. Finally, the last metric I want to compare here is the beta. This is how volatile the stock is compared to the market as a whole. In this case, AT&T is pretty low. Now let's look at Meta to compare. Meta does pay a dividend, however at 0.39% is so low it's basically a dino, dividend in name only. The PE ratio is higher than the overall market average and much higher than AT&T. Where the beta is above 1, it means the stock is more volatile than the overall market. The higher the beta, the more volatile. Already we can see that these types of stocks are not similar at all. One is priced as if it won't grow much at all, pays a significant dividend from its profits, and is much less volatile than the market. The other is, well, basically the opposite. Now we still have one more to look at, Netflix. Let's take a look at that one. Netflix doesn't even pay a dividend, and it's likely not at that level of company development yet, so there's no spare money to be paid out. Obviously a very different situation to AT&T. Its PE ratio is the highest of the three at 49.68, and this means that people are expecting the company to grow further as they're paying $49.68 for each dollar of current profit. Finally, the beta is 1.22, so again, another company that's more volatile than the market. So can you really say that these stocks are in the same sector are comparable? Not really. This is obviously a big problem for dividend investors trying to diversify an income portfolio. However, I have a solution, a new sector classification that is much better for dividend investors. But first, if you're wondering where I got these screenshots from, then it's Trading 212, which is also my recommended investment app for dividend investors. They've also kindly sponsored this video you're watching now. On top of that, I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. So if you've opened a new account recently or planning to open an account, then here it is. DivXP or DIVEXP, short for the dividend experiment. Even if you've already opened the account, you can still have 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. Okay, so what is my big idea? It's some adjusted categories for dividend investors to help decide which sectors you're more likely to find what I call natural dividend payers. These are essentially the type of companies that should be paying dividends, and there are many companies that definitely shouldn't. I made a few videos about this topic before, so I won't go into super detail here, but essentially a company that has a predictable flow of income, so think things like subscriptions, has a significant level of profit, hit a mature level of its company's development, produces and sells something in demand, things like needs rather than wants, has a sustainable client or customer base, and has a strong moat. To give a more tangible example, National Grid, the energy infrastructure company, fits the natural dividend payer archetype very well. It's at a mature level of development, its moat is protected by government licenses, and it provides a need, etc. Looking at National Grid, we can see that it does pay a sizable dividend and has a lengthy history of paying it as it's at the natural dividend payer stage of its development as a business. If we're looking for natural dividend payers, we want to organise the sectors into easier to interpret categories, then we can focus on categories that tend towards being natural dividend payers. So I made these categories instead: energy and commodities, banks and financials, utilities and infrastructure, real estate, consumer necessity, components and production, pharmaceuticals and medical research, innovative tech, and consumer luxury. Now some of these are more inclined to have natural dividend payers than others, and I'll go through the ones most likely to find natural dividend payers. Utilities and infrastructure. Companies here have to be pretty tragically bad to lose their license, which keeps their business in place. They're also permitted an amount of profit per year that can be dispersed to shareholders. These companies often have large capital expenditure, so aren't going to be insanely profitable, but are often very reliable as dividend-paying companies. I mix utilities and infrastructure together, and I would include telecommunications in here, as it's essentially infrastructure at this point in our society. Banks and financials. Companies in this sector are pretty good dividend payers. They deal with capital and moving capital around, so paying out dividends is relatively simple. They do tend to get picked on during tough times in the economy, and governments may force them to pause dividends, but otherwise they tend to be pretty reliable payers. I would put banks, obviously, then insurance type companies, and also business development companies in this section. Basically, anything that's to do with managing money goes in here. Real estate. REITs or real estate investment trusts are pretty good natural dividend payers. They get regular payments of rent and are mandated to pay out a huge chunk of profits to shareholders as part of their business structure. Anything to do with real estate goes in this section, and it's similar to the original category really. Consumer necessity. This is one that's slightly a bigger shake-up. The meaning of necessity here is more in the style of economic concept of a necessity, i.e. something that has a price elasticity of demand under 1. This may mean that some things we wouldn't usually describe as being necessary, like tobacco or alcohol, actually come under this category, as people still tend to spend on it even if the prices go up, or if their incomes go down. Components and production. Think about industrials in the previous categorization, but including some other companies that are more production focused. So what would be considered as tech companies, but in fact more hardware focused, can go in this category. Medical device companies also go in here, as making a hospital bed equipment is different to biopharmaceutical research. Like industrials, this is a pretty good sector to find natural dividend payers. Energy and commodities. This pairing makes less sense in the general stock market, but a lot of sense for us. Energy is essentially a commodity, as we've reduced it to just oil, gas and coal now that utilities and infrastructure have taken all the pipelines etc. out of it, and they're all pretty cyclical as industries, so you'll most likely want to go with the bigger super majors if you want reliable dividend income from energy and commodities sector. And then there are some categories where I think it'd be very unlikely to find natural dividend payers, to the point where I'd probably avoid these categories as a starting point to look when building a dividend portfolio. Pharmaceuticals and medical research. Pharmaceuticals, especially in the early stage, don't really have much business paying dividends. They should be using their capital to focus on research and development, as that is likely to have a much higher return on capital invested than paying it out to us shareholders, assuming that they are successful, which you'd have to assume they are, or why invest in them in the first place. There is an argument that once a pharmaceutical company grows large enough, as in so-called big pharma, it should be moved to consumer necessity. Think companies like Novo Nordisk, Pfizer, or AbbVie, where they supply widely used medicines that more closely fit the description of a consumer necessity. Let me know what you think about that. Innovative technology. Like biopharmaceuticals, companies in the innovative tech sector are most likely going to get better returns for shareholders by just doing their thing rather than paying out dividends. So let them do their thing. On top of that, a lot of these companies are burning through venture capital funds, so aren't profitable enough to be paying dividends anyway. Once they're big enough to be making substantial profits, they're probably going to move into either consumer luxury, like Apple, or they can move into components and production, like Cisco or Seagate. Consumer luxury. Where consumer necessities are things that people are willing to continue to buy even if the price goes up or their income comes down, consumer luxury is the opposite of that. These are things that people ditch as soon as the going gets tough, or generally buy less of. And these aren't usually great dividend payers as their fate is linked heavily to the economy. When the economy is going well, then they might pay out dividends, but then sharply cut when the economy is not going so well. Fashion also goes in here as people can turn on a dime, and something that's popular now may well be very unpopular at any moment. I would also put automobiles in this section, and I think they often have high yields that seem attractive, but can be very unreliable stocks. So those are the categories I have so far. But this solution is not perfect yet, and I've already thought of a few types of stocks that don't really fit in. Shipping companies. Can't really cast them as components in production, and I'd argue they're not very good dividend payers due to the super cyclical nature of their companies, so wouldn't want them to go in that category anyway. Do they need a new category? But if so, what else would go with it? Companies that provide services with personnel. So companies like G4S or Page Recruitment, they would have gone in the old category of industrials as they're industry adjacent, but aren't really components in production and don't really fit with others in that category that I made. Finally, internet-based stocks that aren't exactly innovative tech, like Rightmove and Money Supermarket. Do we lump them in with innovative tech anyway? Which seems a shame, as Money Supermarket does appear to be quite a reliable payer. At least its recent history has been decent. So I guess it's harder than I thought to make new categories. Let me know if you have better ideas in the comments below.
If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!